You can follow all the conventional financial advice, saving diligently, investing early, putting in 60-hour weeks, and still feel like your net worth is stuck in neutral. Bridging that gap meant moving beyond the middle-class obsession with saving. When I started managing billions at Goldman Sachs, I noticed a recurring pattern among the ultra-wealthy that flatly contradicted everything I'd been told about working hard for a paycheck. The data backs this up. If you analyze the Forbes 400 list, you'll find exactly 0 people who reached those heights through a salary or earned income alone. The trap most people fall into is confusing fast action with fast results. Take a real estate flipper. They buy a property, pour money into a rehab, sell it, and immediately repeat the process. They generate cash, but their actual net worth barely inches forward. Now look at a holder. An investor buys a single-family home, waits a few years, extracts the value to buy a fourplex, and waits again. By allowing time to do the heavy lifting, the holder ends up with 5 times the net worth of the constantly working flipper. The ultra-wealthy don't rely on constant motion. They rely on an architecture built around 3 pillars: momentum to compound money, structure to control the outcomes, and asymmetry to maximize the upside while strictly limiting the downside. Playing the game of speed and cash flow keeps you permanently on the treadmill. To escape it, stop working for dollars and start leveraging the physics of time. There is a strict dividing line in finance. Cash flow pays for your current lifestyle, but owning equity, a percentage of a business or asset, is what creates future freedom. McDonald's is a prime example. The burgers and fries generate the daily cash flow, but their true multi-billion-dollar wealth sits in an entirely different category, holding massive amounts of real estate and franchise royalties. To build that kind of equity without draining their own cash reserves, billionaires use a highly misunderstood tool: leverage. Leverage is simply using borrowed capital to multiply your purchasing power. We saw an absolute masterclass in this strategy when Elon Musk acquired Twitter. Instead of selling assets for $44 billion, Musk pledged his Tesla shares to a bank as collateral. By doing this, he secured a massive line of credit. Because leverage is debt, not revenue, it bypasses income entirely, triggering 0 immediate tax liabilities. This mechanism multiplies purchasing power while serving as a shield against the ultimate wealth killer: taxes. But this raises an obvious question. If leverage multiplies your financial upside, doesn't it also multiply your risk of total financial ruin? This chart shows how venture capital solves risk through asymmetry. A firm invests $500,000 across 5 startups. Even if 4 go to 0, the one surviving investment returns 100x. The single winner eclipses the losses, generating a massive profit. Billionaire investor Ray Dalio established a definitive framework for evaluating whether an investment actually provides this kind of safe asymmetry. This graph illustrates the trap most investors fall into. To get a higher return, they blindly increase risk. Dalio targets the exact same high return, but mathematically drives the risk downward. The upside remains the same, but the exposure drops. Contrast that controlled strategy with a man who found a seemingly perfect oil and gas deal. He bet his entire $700,000 life savings on it. When the single deal collapsed 2 years later, 15 years of accumulated wealth vanished instantly because he failed to size his position. The absolute rule of asymmetry is survival. You have to strictly cap your downside so that a single bad bet never wipes out the empire you've built. There is one final contradiction in the money game. Wall Street universally preaches that you must diversify your investments across dozens of assets. Yet almost every ultra-wealthy person does the exact opposite. The brutal truth is that widespread diversification is largely a hedge against ignorance. If you don't know what you're doing, you spread your bets. Titans like Elon Musk, Bill Gates, and Jeff Bezos hold almost their entire net worth in a single, highly concentrated asset, their own companies. They refuse to diversify because they possess absolute control over the operation. They have deep insider understanding of the mechanics and the direct ability to influence the final outcome. Risk drops when control increases. Before allocating capital, run it through this 5-question filter. Does the asset compound over time? Secondly, who actually controls it? And what is the absolute worst-case failure state? Is the upside highly asymmetric to the downside? And do you deeply understand the mechanics of the risk? Wealth is not a lottery ticket, and it doesn't manifest just because you decide to work longer hours. When you abandon arbitrary financial rules and align your capital with the strict laws of time, leverage, and asymmetric risk, compounding wealth then becomes a structural certainty.